we start off looking at gas, maintenance is a key driver at the moment. We've got both Norwegian continental shelf and UK continental shelf maintenance on at the moment that's significantly reducing gas flows into the UK, and at the moment that's facilitating some increased system tightness. On top of that, LNG gas flows, which have been quite strong over recent weeks because the schedule's been really robust, they've actually started to dwindle off, and that's linked with the fact that we're probably seeing Qatari maintenance at the moment, so the cargoes aren't able to get into the terminals to fill up to then come over to the UK and Europe. So because the cargo schedule's slowing down a little bit, we're seeing less gas, which means the terminals are sending less out into the system. If we look at temperatures, this is a potential success story for gas at the moment. We're seeing temperatures increase, which is likely to dampen demand and which could act to alleviate some of the system tightness going forward. Sticking with temperatures, if we actually look at it in terms of power, it's actually something that's going to push prices up potentially as we see increased AC demand. So as it's warm in offices and buildings across the country, AC gets turned on to cope with that heat, and that's obviously adding an increased demand to the power system. Also, we've seen a revision in nuclear maintenance, so we were expecting 2 units to come back in the middle of this week. They've both been delayed and are due back at the end of the week, which is potentially going to see system tightness on the power market sustained for a little bit longer. If we now look at oil prices, last week was potentially going to be a bit of a key week. There was an OPEC meeting, one of the biannual ones, normally in June and one in November. So this meeting is where they typically discuss production levels for the following 6 months. But part of this negotiations, they actually agreed to keep them pretty flat and not change. So that's basically had very little impact on prices. There were a few throwaway comments that had potential to spur some movement in terms of prices. Saudi stated that they weren't intending to increase their own production, they weren't going to flood the market to deflate prices. However, to counter that, Iran said that they are still looking to increase production, even though they've got to pre-sanction levels now. They're still looking to increase that production further and regain even more market share. So if we start off looking at gas contracts relatively close to delivery, we've seen them trade higher over recent weeks, and again that's linked into the fact we've got all this maintenance going on at the moment, as well as these lower LNG gas flows. That's having a knock-on effect on seasonal prices, which themselves, supported by the contracts close to delivery, have traded above April's highs and are now pushing back towards November levels. Going forward, this is a signal that could see prices continue to increase because they've managed to break through a previous high, and if they continue to tick up, the upward incentive is going to build and build and build, and potentially we could see prices start to run away with themselves a little bit. The story is really similar in terms of power. It's pretty much following gas to the T, as it has done over the last 18 months. But again, this inconsistencies with short-term supply-demand fundamentals and the fact that we've seen delayed maintenance returns and increased demand through conditioning, it's just exacerbated the situation and seen seasonal power prices similarly increase. Finally, looking at oil, prices have consolidated around $50 a barrel. They're really struggling to break through that level, and it's proven key in the past. If we looked at prices on the way down, they stopped and hovered around $50 per barrel for a good while, and it looks like on the up move they're looking to do the same. It's potentially going to take a significant fundamental change to see prices push through that $50 per barrel level, but that by no means doesn't mean it's a possibility, and over the short term, if anything, it looks like prices are more likely to move up than down. So customers looking to place fixed price contracts, I'd urge you to enter the market now. We've potentially seen the bottom of the market back in January, and prices have gradually ticked up from that point. The fact that we've recently breached April highs is a potential sign that prices could continue to increase over the short to medium term. So therefore, as a way of mitigating your risk, I would enter the market and place your fixed price contracts now. The fact that prices are low over a number of years would potentially be a strong incentive for you to, when you place those contracts, to place it over a 3, 4, 5 year period, providing you've got credit to do so. Customers with flexible contracts, it's down to attitude to risk. At the moment, prices have moved up and potentially are going to continue to do over the short term. So if you've got very little cover, it might be worth increasing hedges and taking advantage of prices where they are. However, the recommendation isn't to close out all your volume, as because in Q3 this year we're expecting prices to potentially turn downward again as we get strong US LNG volumes and demand typically lower, which could see prices fall in the medium term.